What's up, traders? So today I'm going to show you one of the best option strategies to use to bring in over $20,000 per month. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple six figures a year from the stock market, and I use the money that I make from the stock market in order to pay for my entire lifestyle. Now, I recently had a Zoom meeting with one of my one-on-one coaching clients, and this was the first session we've had together, so I was gathering information about them, such as their account size, their goals, and their risk tolerance, so I can make them a customized trading plan that fits their needs. Well, he shared with me that his account was multiple six figures, and he had recently purchased 1,100 shares of Tesla. And he was very, very bullish on Tesla, and he was thinking about buying leaps, and he wanted to know the best way to enter into that strategy. And so I started thinking, and at this point, I know that he has a ton of shares of Tesla, and he's obviously very bullish on Tesla because he wants to enter into even more trades. And so once he gave me that information, I started teaching him about a strategy called the covered strangle. But before I show you the strategy and how I would enter into a covered strangle, make sure you like this video. It will help it get pushed out to more people. And make sure you subscribe to the channel as well. And do remember that I am not a financial advisor, and this is not financial advice. All trading comes with risks. I'm just showing you how I built wealth over time. All right, so what is a covered strangle? So first off, it is a neutral to mildly bullish strategy that combines a covered call and a short put. All right, so if you're new to options, when you sell a covered call, you are agreeing to sell shares of a company that you already own at a fixed price, and you get paid for doing so. And then when you sell a put, you are agreeing to buy a company at a lower price, and you get paid for doing so as well. Now, every contract is worth 100 shares. So to sell a covered call, you would need 100 shares of whatever company that you're selling the contract on. And then when you sell a put, you are agreeing to buy 100 shares per contract of that company. Okay, with options, it's all about 100. So the first benefit of a covered strangle is you generate income. In this case, you earn money from both the put and the call. All right, and so with the gentleman that I was coaching, because he had already had 1,100 shares of Tesla, I immediately thought, well, instead of him buying calls, why don't we just sell aggressive puts so that we at least have a little bit of margin of error since we already have 1,100 shares of the company. And this is a neutral to bullish strategy. You will profit if the stock stays between strikes or rises slightly. Thirdly, you get to buy at a discount, right? So when you sell the puts, if you were assigned more shares, then you get to purchase those shares at that cheaper price. And then it is a limited upside because your gains are capped because of the covered call. All right, so how do you place a trade? You would first need at least 100 shares of the stock. And then secondly, you would sell a call, and this obligates you to sell the stock at the strike price. And then you would also sell a put for the exact same expiration. And this obligates you to buy the stock if the price drops below your strike price by the expiration date. All right, so here's a quick example. So let's suppose ABC stock is trading for $100 currently. Well, what we would need to do is first buy 100 shares of the company if we don't already have the shares. And then we could sell to open a call at, let's say, $110 for about a month out. And we'll get paid, for this example, $1.50. Now, for anyone who's new to options, every contract is worth 100 shares. So the price you see is always times by 100. So in this case, we would receive $150 up front. Okay, now we've placed our covered call, but now we go down and we sell to open a put for any price under 100. In this example, we did $90 for the exact same expiration, and we got paid the same amount of $150. So in this example here, we got paid $300 total for opening up this covered strangle. So here are your possible outcomes. If the stock price stays between the $90 put and the $100 10 call, well, both the call and the put options expire worthless, which means you just keep the $300 you were paid and you go about your life, and then you can continue to do the strategy over and over and over again if you wish. Okay, and that is often what traders prefer the most. Now, the best case scenario is that the stock price goes all the way up just under $110, because in that case, we still keep all of the premium that we received from selling the contracts, but also we get the capital appreciation of the stock rising. So you're kind of making money in three ways. You're making money from selling puts, you're making money from selling calls, and you're making money from the stock going up. Okay, so that is scenario number one. And then scenario number two is that the stock price rises above your call strike of $110. Well, in this case, the call option is exercised, which means you're forced to sell your shares of the stock at $110. Now, you're fine with that because you bought it for $100. So you still get all the capital appreciation all the way up to $110. And no matter what happens with the stock's price, you always get to keep the premium. So you still made $300 from both the put and the call, and then you got a 10% profit from the capital appreciation of the stock. You'll just be forced to sell your shares of the company by the expiration date. All right, so that is scenario number two. Now let's check out scenario number three. So scenario number three is if the price drops below your $90 put. In this case, the put option would be assigned, which means you have to purchase 100 shares of the company at the strike price. So we will purchase 100 shares at $90. So that would be $9,000 in total that you would have to pay for that stock per contract that you have. All right, so what are the pros of the covered strangle? One is obviously the income generation and the possible capital appreciation. And then secondly, you get to reduce your cost basis if the stock were to drop below your sold put. And if this is truly a company that you actually believe in, you should like getting more shares at the lower price. And the con is there's theoretical unlimited downside risk because technically if you buy a stock, it could go to zero. All right, but the plan is that you're doing this on great companies that have a very slim chance of ever going to zero. And then the second con is you have limited upside potential. Because of that covered call that you are selling, your max profit will always be at the strike price that you set. Now, before we head over to Thinkorswim and I show you the best ways to enter into a covered strangle, if you know anybody that you think can benefit from learning from me, please let them know about the Trade to Freedom community. Not only will they get my actual trades as soon as I enter them, but they'll also get my entire Trade to Freedom course, which teaches you about options from A to Z. And then thirdly, they'll be within a community from beginners to experts that all have the exact same goals as them. The link is in the description below if you know of anybody. All right, so here we are in the Thinkorswim platform, and I have Tesla pulled up in the options chain. Now, doing this specific option strategy on Tesla is more for people with larger accounts, but make sure you stay to the end because I'll show you a way that you can enter into this exact same trade, even if you have a smaller account. Now, we can see that Tesla is currently $379. Which means if you don't already have shares of the company, you'll need to pay $37,900 for 100 shares. Now, there is a way to do it with long calls, which will lessen your price. However, for the purposes of this video, we are going to use the shares of the company. But again, stay to the end because I'll show you a way to do this trade with a much lesser account. All right, so the first thing we need to do is select an expiration date. Now, I go up to 45 days out. And that doesn't mean that I'm selecting 45 days. I may select 30, I may select 21 days, I may select 7 days, but 45 is my max. And the reason for that, as an option seller, time value starts to decay even more during the last 45 days of an options contract, which is exactly what you want as an option seller, because as an option seller, you want to receive a large amount and you want to pay a small amount back. Okay, I'm looking over here, and for this trade, I'm going to go out to this 44-day out expiration date. So I'll select that. And now that we have the expiration date selected, let's go ahead and scroll down. And for the purposes of this video, we're going to assume that you already have the 100 shares. So we'll scroll down. And the first thing we need to do is select our put. And so I'm going to look at the delta column. So here is the delta column here. And the delta just shows you how much an options premium will move per a $1 move in the stock's price. However, most successful traders look at the delta as the probability of the event occurring. So in that case, if we were to go to a 0.10 delta at this $305 strike, for me, that tells me there's about a 10% probability that Tesla's stock price, which is currently at $379, drops down to $305 by this expiration date. So in other words, if I were to sell a put here, I have about a 90% probability of profit. Now remember, with the gentleman I was speaking to, he was very, very bullish on Tesla. And initially, before I changed his mind, he was thinking of buying leaps at that time. And so I said, hey, if you're that bullish on Tesla, why don't we sell very aggressive puts? Because if you truly believe that it's going to continue to go up over long periods of time, then one, you should be happy with owning shares of the company at the cheaper price. Two, this will give you a margin of error, so it will allow Tesla's price to drop some without you losing money. And three, you'll get amazing monthly income from it. So if my memory recalls, I believe we decided on a delta of about 0.30. So I'll scroll down here. Looks like this strike here at $350 is a delta of 0.28. So that gets us close enough. So I'll go ahead and right click, hit sell, and then I will go to Strangle. All right, so it automatically inputted our $350 put, but now we need to select what call strike we would like. All right, so I'll come over here. Now, if we follow the exact same rules and go to about a 0.30 delta, that will put us at this strike of about $430. Now, if you're super, super bullish on it and you think that it's going to skyrocket beyond 430 within this 44 days, then you can select a different strike. I mean, you can come down as far as you want to. Really, just keep in mind that you'll make less money the further from the stock price that you go. But for the purposes of this video, let's just stick with that exact same delta. So we'll do the strike of $430 for the call. So let me come over here and select 430 for the call. Scroll. Perfect. All right. So we have a put of 350 and we have a call of 430. And as long as Tesla's stock stays between those prices, we just keep our money and go about our day. And we can continue to do that trade over and over again. However, if Tesla's stock price goes above our $430 call, then we'll be forced to sell our shares. And if the Tesla stock price goes below our $350 put, we'll be forced to buy the shares. All right, so perfect. So next thing we need to do is select the amount of contracts that we want to do. Now, like I said, this gentleman had 1,100 shares and he was willing to put more into Tesla. So we went ahead and sold 11 contracts. And if we come over here and select the mid price, we will get $2,660 per contract that we sell. And if we come over here and hit confirm and send, we would immediately receive $29,260, which is a nice little chunk of change over the next 44 days, especially for this gentleman because the Tesla shares were a little under 40% of his account. So he still had the other 60% of his account to use his buying power for different trades. Now, let me take you over to the Analyze tab so I can show you how much this trade will be worth by the expiration date, depending on what price Tesla is trading at the time. All right, so here we are at the Analyze tab, and I have the trade pulled up. Now, if we look at this X-axis down here, this is the price of the stock over time. And then on the Y-axis is how much we will either make or lose from this trade. Now, what I want you to do is pay attention to the blue number at the bottom left, because that will show us how much the trade is worth on the expiration date, depending on where Tesla's stock price is at. Now, Tesla's stock price is currently $379. Now, this is assuming that you purchased the shares today. Now, the gentleman that I've been speaking of, he purchased the shares a while ago, so he has a different cost basis. However, if we purchase the shares today, and you can see if it just stays the same and the stock price doesn't move at all, by the expiration date, we will make $29,359 from this trade. But here's the thing, if Tesla stock price goes up, you can see how it continuously is going up and up and up. Because remember, not only are we making money from the sold put, but we're also making money from the sold call. And then also we're getting the capital appreciation of the stock as it goes up higher. So I'll slowly continue on, and we can see how the number is getting higher and higher and higher. And it's going to continue to rise all the way up to our short call, which is $430. So once we hit this $430 mark, we have received the max that we will receive for this trade. And if you look at the bottom there, he will be set to make, if this happens, $85,525 over the next 44 days. And that is crazy to think about, making that much just off of one trade. Now, that is on the bullish side. But on the bearish side, now remember, we do own the shares of the company. So if the price goes down, then we will start to lose money. All right, so let's go down, let's scroll down, making less money. All right, we passed our cost basis here, and this will still be a profitable trade all the way down to, looks like $352. All right, now once it hits 352 is where we will start to actually lose money on this trade. So you can see as we go lower and lower, you will make less and less money. And if it goes beyond the $350 put, he will be forced to buy 100 shares of the company per contract that he has, which he is totally fine with because he wanted to purchase leaps on Tesla when the stock price was even higher than what it is today. So by doing this, he created a nice little margin of error for himself. Now you're probably thinking, Rashad, that's great and all, but I don't have $38,000, $37,000 to drop on 100 shares of Tesla. Well, no worries. That's where leveraged ETFs come in. Well, a leveraged ETF is simply an ETF that looks to follow a specific stock or sector and move 2 or 3 times it per day. So an example is ticker symbol TSLL is a leveraged ETF to Tesla, and it looks to move 2 times more than the daily move of Tesla. So for example, if Tesla moves up 1%, TSLL moves up 2% for the day. And the same works for in reverse. If Tesla were to move down 1% for the day, then TSLL will look to move down 2% for the day. Now, the reason I like trading leveraged ETFs is one, because you get more premium as an option seller, because the more volatile a stock is, the more premium that is in each contract. And so for taking on more risk, you get paid more. Now, the key with leveraged ETFs is to only do these trades on companies that you would actually like to own. All right. And then the second reason I like trading leveraged ETFs is because the stock price is typically much cheaper than the stock or the sector that it follows. So I currently have TSLL pulled up here, and you can see that the stock price is currently $23, which is a lot easier to sell options on compared to a stock that's $379. So assuming that we already have the 100 shares of the company, we'll go ahead and do the exact same type of trade. So I'll come over here to the 44-day out expiration date. All right, so same thing, we'll come over here to the delta column. Now you could go 0.30 delta again. However, I personally like to be a little bit more conservative when it comes to leveraged ETFs. So maybe instead of this 0.30 delta, maybe we come down to closer to a 0.20 delta. And that'll put us at a sold put of $18.70. So let's go ahead and select that, go sell, and then come over here to Strangle. Perfect. Now let's scroll down and we need to select our short call. Now, when it comes to the call side, you can be really as aggressive as you want because you already own the 100 shares of the stock. And so your stock will literally cover the call. So you could come over here and do like a 0.51 delta if you wanted to. But for the purposes of this video, let's just stick to a delta of 0.30. and that'll put us at a strike of $30.70. So I'll come down here, I'll select $30.70, and that is perfect to me. Now you can select however many strikes you like, but you can see at the mid price we'll get $270 per contract. And so if we go ahead and match it to the exact same example before when the gentleman did 11 contracts, come over here, hit confirm, and your max profit would be $2,970. And that is well over a 10% return on your investment over a course of 44 days, which is pretty amazing, seeming as the market only averages about 10% per year. Well, ladies and gentlemen, if you know anybody that you think could learn from me and wants to join the Trader Freedom community, please share the link below in the description. Not only will they get my actual trades when I enter them, but they'll also get my full options course that goes over all of my strategies. And lastly, they'll be within a community of other traders that all have the exact same goals. But that's it for this video. Make sure you like this video and subscribe to the channel, and I will see you guys on the next video. Peace!